So, let's start with a question that sounds, well, kind of impossible. How can your investment portfolio actually gain money when the overall market is tanking? I mean, it just feels like that shouldn't happen, right? Well, today we're going to break down exactly how one systematic strategy did just that. Let's dive in.
This really is the million-dollar question, isn't it? Look, anybody can look like a genius when we're in a bull market and everything's just going straight up. But the real test, the true test of any strategy, is what happens when that tide goes out. How does it handle the bad times? Can you really pull out a positive return while the benchmark is in the red? Well, let's see the proof.
And here it is. Check out these numbers from February 2026. The S&P 500, the benchmark for the entire US market, it dropped almost a full percent. But this portfolio, it was up nearly 3%. Now, the really cool part here is that this wasn't some lucky guess. It wasn't a wild speculative bet. This was a result of a disciplined, predefined system just doing its thing, executing its plan flawlessly.
So what's the secret sauce behind these numbers? It all comes down to this really elegant structure called the 80-20 system. And this isn't just one strategy. It's actually a combination of two different strategies that are designed to work together, kind of like a finely tuned engine where every part has a very specific job to do. So let's pop the hood and see how it works.
All right, so the first part, which makes up a huge 80% of the portfolio, is called Titan. You can think of this as the bedrock, right? The solid foundation. It's built for steady, long-term growth. It's a buy and hold strategy that uses defensive assets and a little bit of controlled leverage. It's built to be stable, and it only gets rebalanced once a year. Then you've got the other 20%. This is the tactical shield, and it's called Dually. Now, this part is way more nimble. It rebalances every single month to react to what the market is doing right now. Its job is to adapt, to chase growth when things are hot, and more importantly, to shift into a defensive mode when things start to look a little shaky.
So how did that tactical Dually shield actually work in February? This is where we get to see the real magic of what's called a defensive rotation. This is the key. This is the mechanism that automatically protected the portfolio from that market slide, and it's the exact reason we saw those positive numbers.
The whole thing is based on this really cool concept called dual momentum. Now, the most important thing to understand here is that the system doesn't try to predict the future. It doesn't have a crystal ball. What it does is it reacts to what the market is telling it right now. So, to put it simply, if stocks have been doing great lately, it buys more stocks. But if something like bonds or gold starts to outperform stocks, it automatically and systematically shifts into those assets. It's just a disciplined, rules-based approach that follows the trend. No emotion, no guesswork.
And this is exactly what went down in February. At the end of January, the system saw that momentum in stocks was getting weaker, so it just followed its rules. I mean, look at this allocation. Over half of the entire tactical part of the portfolio was moved into defensive things, like gold and long-term treasuries. That defensive shift is precisely what allowed the portfolio to make money while most of the market was losing it.
Now, I've mentioned leverage a couple of times, and I know for a lot of investors that word can be pretty scary. It brings to mind high-risk gambling, right? But in this system, leverage or margin is used as a very, very disciplined tool. It has incredibly strict safety measures or guardrails in place. Let's see exactly how that works.
The single most important rule here is to keep that margin usage extremely low. I mean, right now it's sitting at just 2.74% of the total portfolio value. See, this is not about making some huge, risky bet to chase crazy games. It's about using a small, controlled amount of leverage to methodically and safely amplify the returns of the strategy, all while staying deep inside the safety zone.
And this right here is the brain of the whole safety operation, the margin traffic light. It's designed to take all of the emotion, all of the guesswork right out of the equation. As long as margin is under 10%, everything is green, we just proceed as planned. If it ever hits the yellow zone, we just stop adding margin. Simple. If it gets to orange, we start to actively pay it down. And red, that's an emergency stop. But at just 2.74%, we are deep, deep in the green with plenty of room to breathe.
Okay, so that's the how, right? We've seen the two-part structure, the defensive rotation, the safety guardrails. Now let's get to the what. What were the actual results after the first 4 months of putting this whole system into practice?
The numbers really do speak for themselves here. From the end of October 2025 all the way to the end of February 2026, this portfolio returned 7.3%. And during that exact same time, the S&P 500 was basically flat. That's a total outperformance of nearly 7% in just 4 months. That, right there, is the power of a disciplined, systematic approach.
And here's where that super disciplined use of leverage really shines. The total interest paid on that borrowed margin was just $2.65, and that tiny little cost helped generate a net profit of over $32. That's a return on investment of over 1,200%. Again, this isn't about wild speculation. It's about using leverage as an incredibly efficient tool to accelerate returns in a controlled, methodical way.
But, as we all know, past performance is no guarantee of future results, and the market never, ever stands still. So as we head into March 2026, there are new challenges on the horizon, including some rising geopolitical tensions between Iran and the US. So the question is, how is the system positioned to handle this new uncertainty?
So here's the reality check for March. Yeah, with all the increased volatility, the portfolio has pulled back a little bit from its recent highs. That's totally expected. But the system's response is beautifully simple. Stick to the plan. You just continue the systematic contributions. Because that defensive shield from Dooley, it's already in place. And the margin traffic light, still solidly green. The most important thing to do right now is not react emotionally to the headlines, but instead, just trust the system to do its job.
And look, if you take away just one single thing from all of this today, please let it be this. A successful investment system isn't a crystal ball. It doesn't claim it can predict the future. What it does is it prepares for it. It builds this robust, rules-based framework and it can handle whatever the market throws at it, with discipline and without emotion.
And of course, a quick but very important note. This has been an educational breakdown of one specific investment strategy. This is not financial advice. All investing involves risk, including the potential loss of your money, and past performance never guarantees future results. Always do your own research, and please talk to a qualified financial advisor before you make any investment decisions.